Your credit score is not a measure of how much money you have. It is not a measure of how smart you are with money. It is not even a measure of whether you are good at managing your finances overall. A person with a high income and a large savings account can have a terrible credit score. A person who barely saves anything can have an excellent credit score. So what is this number actually measuring? By the end of this video, you will understand exactly what a credit score tracks, why it works the way it does, and why that matters when you apply for a loan or a credit card. A credit score is a prediction. Specifically, it predicts how likely you are to pay back borrowed money on time over the next 2 years or so. That is it. It is not judging your character. It is not measuring your net worth. It is answering one narrow question. If a lender gives you money today, what are the odds you will make every required payment on schedule for the foreseeable future? To make that prediction, the score looks at your borrowing history. It examines patterns in how you have handled debt in the past. The assumption is that past behavior is the best available clue to future behavior. Think of it like a weather forecast. A forecast does not measure how much you personally like sunshine. It predicts whether it will rain tomorrow based on patterns in temperature, pressure, and humidity. A credit score does the same thing for lending risk. It takes data about your past and turns it into a probability. The score itself is just a number, usually between 300 and 850. Higher numbers mean lower predicted risk. Lower numbers mean higher predicted risk. Lenders use this number to decide whether to approve your application and at what interest rate. A higher score generally gets you better terms because the lender sees you as less risky. Now, the score is calculated by looking at 5 main categories of information. Payment history is the biggest factor. It checks whether you have paid previous debts on time. Late payments, missed payments, or accounts sent to collections all hurt this part of the score. The second factor is amounts owed, especially how much of your available credit you are currently using. If you have a credit card with a $1,000 limit and you are using $900 of it, that signals higher risk than using $100 of it. The third factor is length of credit history. How long have your accounts been open? Longer history generally helps because it gives more data to analyze. The fourth factor is credit mix. Do you have experience managing different types of credit, like a car loan and a credit card, or just one type? And the fifth factor is new credit. Have you opened several new accounts recently? Opening many accounts in a short time can look risky. These 5 categories get weighted differently. Payment history and amounts owed together make up roughly 2/3 of the score. The other 3 categories matter, but less. The score does not look at your income. It does not look at your savings. It does not look at your rent payments in most cases, unless you specifically use a service that reports rent to credit bureaus. It only looks at your track record with borrowed money that gets reported to the credit bureaus. Let us walk through a simplified example to see how this works in practice. Imagine 2 people, person A and person B. Person A earns $100,000 a year and has $50,000 in a savings account. Person A has never used a credit card and has never taken out a loan. Person A pays for everything with cash or a debit card. Person B earns $30,000 a year and has almost no savings. But Person B has had a credit card for 5 years. Every month, Person B charges small purchases to the card, then pays the full balance on time. Person B also took out a small car loan 3 years ago and has made every payment on schedule. Now both people apply for a car loan at the same bank. Who do you think gets the better interest rate? Most people guess Person A, because Person A clearly has more money. But the answer is Person B. Person A has no credit score, or a very thin credit file with almost no data. The lender looks at Person A and sees a blank page. There is no borrowing history to analyze. That creates uncertainty, and lenders do not like uncertainty. They may approve Person A for the loan, but probably at a higher interest rate to compensate for that uncertainty. or they may ask for a larger down payment, or they may deny the application entirely. Person B, on the other hand, has a track record. Person B has demonstrated over 5 years that they borrow money and pay it back on time. The score reflects that pattern. Even though Person B earns less and saves less, the lender can predict with reasonable confidence that Person B will make the car loan payments on schedule. So Person B gets approved at a lower rate. This example shows why the score measures behavior, not wealth. Wealth tells you whether someone could pay off a debt if they chose to. Behavior tells you whether they actually will make the required payments on the required schedule. Lenders care more about the second question. One of the biggest misconceptions is that checking your own credit score will hurt your score. This is not true. When you check your own score, that is called a soft inquiry. Soft inquiries do not affect your score at all. You can check as many times as you want. What does affect your score is a hard inquiry. A hard inquiry happens when a lender checks your credit because you applied for a loan or a credit card. Even then, the impact is usually small and temporary. 1 or 2 hard inquiries in a year typically lower your score by less than 5 points, and the effect fades within a few months. The confusion comes from people who apply for many credit cards or loans in a short period. Multiple hard inquiries in quick succession can signal that you are desperately seeking credit, which looks risky. But checking your own score to monitor it, completely harmless. In fact, checking your score regularly is a smart habit because it helps you catch errors or signs of identity theft early. Here is the one thing to remember. Your credit score measures your history of borrowing and repaying money on time. It does not measure how much money you have or how good you are at saving. It measures one specific behavior pattern that lenders care about. If you want a strong score, the key is to borrow occasionally and always pay on schedule. That track record is what the number reflects. If you found this helpful, subscribe for more plain English explanations of personal finance concepts. Next time, we will break down how interest rates actually work and why the same loan can cost very different amounts depending on the rate. Thanks for watching.